Good morning, SMF Street Traders. And one of the things that we're going to be talking about, and we've already talked about it before going on video, I've already given you the prices before going on video, because it's not SMF's responsibility to make the public money, because these videos are for MMTs. Just so happens to be, if you're an innocent bystander and you think that something like this might work for you, well, you can always come visit us and get to know us. So basically what we're going to be doing is that Google's going to report the earnings on October 15th after the closing bell. The equity price, as we've shown, this is a $550 call up and out of the money. The other thing that we're going to look at is the $510 put, which is out of the money, and we're going to put that right there. So on this weekly chart below, you can see where the contracts were on 8/29 at the end of the sell-off in August. These contracts, these put contracts, were $60, and now they're down here at $2.85. That same put contract in MMTs was $5.30 on the Friday's high. So we're going to get down to the wholesale entries that I've given you. Now, what we are going to do is that you've all understood about the mathematical put to call ratio spreads, which are market maker spreads. They're not day trading options and all the wonderful little things you've read in day trading books. That's not this. Sorry. But what I will tell you, it's the difference between deflated pricing mechanisms. We were inflated up here. Here's that call option. That 550 call up and out of the money is right here, MMTs. The high was up here toward $11 and some change. So I've already pulled back about 100%. So basically, what we're going to look at is one of the two sides are going to move based on this directional movement of the equity price. Now, in your SMF platform, which we use, we have our own Google chart right here. And each one of these lines are $9.98. There's a lot of room to go up. And we're going to buy that $510 put. And the reason why we're buying the $510 put, that's where this big part of that breakout bar was. So basically, if we were to gap below half of that weekly bar, let's say it went the opposite way, that half weekly bar, write it down, MMTs, right here, 509.95. Well, that's where the big breakout happened. You were $42.44 above the previous week's bar, half bar movement above it. So basically, when these things are ascending, that's the uptrend in your platform here. So let me get this over here where it's in the video. So you already have your SMF pricing platform, market maker platform. So we have seen it before. If a delta for Monday is $9.98 and you got a 5 delta gap, well, my friends, that's a $50 gap. That would put you right back up here where these mathematical failures happened in its downtrend all the way down here. So we have a burn one and we got a second right. The right side is the upside of the market. That's the right side. That's the upside trend, where basically Google broke its yearly downtrend. We've got a long ways to go up to the highs. So basically, based on the fact that half of that weekly bar is at 509, that's exactly putting this $510 put into play for the options expiration week, MMTs. And we know exactly in our platform where that was. And that's where the biggest weekly breakout has been within the actual weekly trend structure, was right here. I mean, each one, that was 9, so that was 1 teeny, 1 delta, 2 delta, 3 delta times the $27 move in that week. And what it means is when you're breaking trends on a weekly basis, meaning I got cycle 1 and cycle 2. Cycle 2 is longer than cycle 1 in the weekly pattern. The formula's here. So basically what I am going to say is that we have all the pricing right here in the brain. And when I look up and out of the money on Google, and I'll bring this hood down so you can see it, and I'm going to scroll over here, you can see mathematically it's already priced for you. It is. The upside's already priced. So let's go to our brain here and take a look at this column right here, which would be a trend ratio of 2 deltas. That puts you right in this pricing area in this line. That's 555. That's at a 2 deltas. 2 deltas are 998 for Monday. That means that we already know where the pricing is. It prices it all the way up here. Prices it up to the top here at 634.89 in our system. If I go over here, I'm sure it even goes, it'll go higher than that. But the thing about it is that's the current pricing structure. It changes daily. So basically what we're going to do is put on that risk parameter trade based on our platform instead of this standard platform. We already know what it is. So we're going to be getting a 550 call up and out of that money, and we're going to get the $510 put below that market of where that downtrend started. I don't care if it gaps down here. Watch. If it gapped below 510 and they went down in the earnings, well, these calls are deflated. They got a long ways to go. So if I have 10 contracts here, let's say I paid $2.20. That's $2,200 for my downside play. And let's say over here that I get these at, $4.50, $5 for 10 contracts. I got $5 grand in play. I'm less than 10 grand on the whole trade. If it gaps up there, MMTs, if it gaps up here, check it out. If it gaps up here, there's the 550 mark in your platform. It's about right there, right in here. That's where the downtrend started at 600. So we're right over in this area, this teeny line, delta line, right in here, half of that bar. So basically, whether we lost all of this money here, that's fine. And this side of the market goes up to, let's say, $15, $16, $17 a contract on a gap. Well, if I lost $2,500 here and I'm making $10,000 here, well, you take $10,000 minus $2,500 and there's your profits. But you're in play for either one of those big directional movements on options expiration day and earnings Thursday after the close for the Friday morning royal gap. Up or down, MMTs. So basically, 550 call versus 510 put, you've been given a gift.